Welcome to Heller-Hurwicz Office Hours, the podcast where we feature University of Minnesota economists and the research that helps us make sense of a complex world. In this fourth season, we are continuing our deep dive into how rigorous economic research informs our understanding of the rapidly shifting global landscape. Geopolitical conflict, policy uncertainty, and challenges to the Fed's independence are all converging to reshape the nation's economic outlook. Today, we're joined by Neel Kashkari, president of the Federal Reserve Bank of Minneapolis, to discuss this pivotal moment for the U.S. economy. So welcome.
Thank you. Great to be with you.
So the most recent data on the consumer price index is consumer prices rose 3.8% in April from a year ago, and that's up from 3.3% the previous month and 2.4% in February. So how concerned are you? It seems that the progress against inflation not only has stalled, but we're getting some erosion here.
Well, before the Iran conflict started, I was feeling pretty good about where inflation was headed. We made a lot of progress in the prior several years bringing inflation down. It was still too high, but I had confidence it was heading slowly back to the right direction, back to our 2% target. The Iran war has really upended that. And now we've got this energy shock wave ricocheting around the world. Energy, we strip it out and we talk about core inflation. But energy goes into everything. It goes into the food that we eat. It goes into the goods that we buy. Anything that has plastics ultimately comes from oil and petroleum. So energy really matters a lot to the global economy and to what Americans buy. And so right now, there's just a great deal of uncertainty about where inflation is headed because there's so much uncertainty about what's happening in the Middle East right now.
And so you explained in your letter about your dissent, you agreed with the decision that was made by monetary policy to hold rates steady, but you wanted more flexibility about, well, maybe we're going to increase, maybe stay the same or decrease. And so what motivated your dissent?
Well, what you're describing is something that we call, it's a technical term, forward guidance, which is us guiding the financial markets of where monetary policy is likely headed in the future. The reason that that matters is if markets and people believe that rates are going to be lower in the future, that brings forward into some decision making today, and that has the effect of actually easing financial conditions today a little bit. And for the past several months, there's been what we call an easing bias. The language that we use has indicated, hey, the next rate move is likely a decrease. Well, we adopted that language when inflation seemed like it was heading back towards our 2% target. Now that the Iran war has really thrown a curveball at that, and I don't know where inflation is heading, I'm simply saying I don't want to have that easing bias anymore. I think we should be neutral. The next move might be down if the Strait of Hormuz reopens quickly, but it might also be up if it ends up being closed for an extended period of time and if oil prices keep climbing from here.
So one of the things I find fascinating with everything that's been going on, when you look at the Treasury inflation protected securities, looking out several years, it still seems that most investors are optimistic about the inflation front.
Well, it's funny you say that. You're right. So if you look at the data in financial markets, it suggests that inflation will be short-lived and go right back down to our 2% target. So on one hand, that gives us at the Fed some comfort that markets have confidence. But what we don't know, what's embedded into that, is financial markets' beliefs about what we're going to do. So if markets are convinced that the Fed is going to be really aggressive and bring inflation back down to target, then you would see those prices suggest, yes, inflation is going to come back down to target. But then we have to walk the walk. We have to follow through and validate those expectations. And so, yes, it's good that financial markets are indicating inflation will return back to target, but that doesn't get us off the hook. We might still have to deliver the medicine that's necessary in order to achieve that positive inflation path.
And part of this is also, as an institution, the Fed is independent. And there's been obviously President Trump. He'd like to reduce the Fed's independence. How important when we're thinking about inflation being anchored, the inflation expectations being anchored, is Fed independence? Because you've gone through a period of time where you have to sort of like think this through.
Yeah, it's foundational. I mean, if you look around the world, where countries have either they have a central bank that's not independent of short-term political decisions, or that independent gets compromised. Where that shows up is in higher inflation and higher inflation expectations. I'll give you just a perfect example, Argentina. Argentina has this long history of very high inflation. Eventually, there are reforms to bring inflation back down, but the reforms, the institutional reforms, don't persist. And then another government comes in and they say, no, 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 we want to balloon the budget again, or we want to cut rates again. And then those institutional structures are broken and inflation takes off again. And it's very hard to put it back together once you violated that trust. And so think about NATO as another example, very different, a foreign policy
Right.
example. NATO is so powerful because we have this mutual defense pact that if one NATO country is attacked, it's an attack on all. Well, imagine that a NATO country was attacked and then the other countries didn't come to its defense. Are you going to trust it next time? Does the pact have any meaning? And so it's a little bit like the Fed has to walk the walk and get inflation back down, and our political system needs to support us doing so, so that we have that kind of strong credibility in the future.
So speaking of that credibility, what causes inflation? I know that's a naive question, but when you look back at the recent bout of inflation, there's a lot of talk. Well, it's money. That's Milton. We learned from Milton Friedman it's about the money supply, but then we had the post-COVID world with all the supply chain issues, and now we're talking about trust and credibility. You know, how do you now look at inflation? What is it that you pay attention to?
Well, it's a lot of different things. And so, for example, the traditional way over the last several decades that we've thought about inflation is it's been about the labor market. If the labor market gets really tight and the unemployment rate drops, employers are going to have to compete against each other to find workers and to keep their workers. And that means they're going to have to pay their workers more. That means the costs are going to go up for those companies, and they're going to turn around and pass those costs on to their customers. We talk about that as a wage price spiral. Well, in the last 10 years or more, the labor market has been a lousy forecaster of inflation. It has not been wage driven inflation, both when the labor market was weak and when the labor market was strong. It did a terrible job. So there's another one that we learned the hard lesson in COVID. There's supply driven inflation. When COVID hit and supply chains were disrupted and you couldn't get goods from around the world and there wasn't shipping going on, prices went up through the roof. And so there are supply driven disruptions. When Russia invaded Ukraine, that was a supply shock. And so there can be many different root causes of inflation: the labor market, other supply factors as well. And then, of course, there's just aggregate supply of money, which is if the labor market's in balance and if supply chains are working just fine and there's no big disruptions, if we simply flood the country with too many dollars chasing the same number of goods and services, prices are going to go up. And so some of those things the Fed has more control over. The supply of money, we have a lot of control over. We can tap the brakes on the labor market. Supply chains, we don't have the tools to directly affect supply chains.
So, speaking of the labor market, how are you looking at the labor market? It's been at least, what, a year now that we've had this low hire, low fire market. And so, on the one hand, the unemployment number is good. I mean, it's low, and yet when you interview workers, everyone seems nervous.
Yeah. There's a lot of nervousness in the economy. So you're right. The headline unemployment rate is 4.3%. That's not a bad unemployment rate. It's been mostly moving sideways. But as you indicated, there are not a lot of people being hired, and thankfully, not a lot of people being fired. But workers are nervous. There are a lot of surveys done of households and consumers and businesses. There's an overwhelming economic anxiety that many people are experiencing, even though the actual conditions are still pretty decent right now. So, from a monetary policy perspective, we want to get inflation back down, but we want to keep the labor market at least where it is. We don't really want the labor market to weaken from here. You'll hear the term stagflation used. A stagflationary shock, like an oil shock, pushes up prices, but it pushes down on economic activity, and on the margin, it weakens the labor market. That's really difficult for a central bank because we can fix one or the other. But with monetary policy, we can't solve both problems at the same time.
And with that dilemma, My reading of the past couple years is that the Fed will lean toward, if it has a choice, fighting inflation because the recent experience is that people really hate inflation and it is hard to bring down. But am I reading this right?
I think you are. It's going to depend on the circumstances, but it's not just that people really hate inflation, which we were reminded of in the last few years, but we've now had 5+ years of elevated inflation. So when the Fed lifted off of its, we went to cut the rates to zero during COVID, and we finally started raising rates again, inflation had been elevated for about 6 months, and we raised rates really aggressively. Now inflation has been elevated for more than 5 years. And at some point, people are going to say, wait a second, this is the new normal for inflation. We just need to get used to it. And I need to go ask my boss for a bigger raise because my family is not keeping up with where inflation is. And if that happens, if everybody says, I need to go ask for a raise to keep up with inflation, then it becomes embedded in our economy. And then it becomes a very difficult problem to solve. So, yes, people hate inflation, but the longer inflation stays elevated, the more important it is that we actually finish the job and get it all the way back down to our 2% target.
Okay, so with that 2% target, you have this tsunami of investment going on with artificial intelligence and what goes into all of artificial intelligence. And you have improvements in productivity, and some people are attributing, well, if we're going to have improvements in productivity. So, how do you factor into this analysis when you're looking ahead? Do we raise rates? Do we lower rates? Keep them the same? This remarkable technological innovation and all that investment.
I would say there's two parts of that that are related. The first part, most near term, is what does it do to the average rate environment? And what I mean by that is there's some interest rate that neither stimulates the economy nor restrains the economy. It's the neutral rate, we call it. We don't set the neutral rate. We can just try to estimate it. But if there's massive new demand for investment capital going to build data centers and chips and power plants to power those data centers, that's on average going to raise interest rates across the economy because that is how the economy reallocates capital away from other sectors into this data center, IT, AI sector. So, a concrete example, and a stylized example, an apartment building that used to get funded at a 3% mortgage, well, now mortgage rates are going to be elevated. And now mortgage rates, they go up to 6%. And now that builder says, well, that apartment building doesn't make economic sense anymore. I can't afford a 6% mortgage rate. So that apartment building doesn't get built. And instead, that capital goes and builds data centers. So the first thing to keep in mind is this massive new demand for investment capital is probably pushing up interest rates all across the economy to reallocate capital to data centers. So we need to try to estimate that because we need to know, are we stimulating the economy or are we restraining the economy or rates at neutral? I think monetary policy is somewhere around neutral today, maybe slightly restrictive, but that's at a higher rate level than it was before the pandemic because I think that neutral interest rate has gone higher. So that's the first important factor. Second factor is long-term, what does it do for productivity? If AI really boosts productivity structurally over an extended period of time, then we can grow the pie for the American people without having to worry as much about inflation. The growth rate of the economy, the non-inflationary growth rate of the economy will be higher if productivity growth is higher.
What are you watching when it comes to productivity? Because it's a volatile number. It can get revised a lot, but it has been it's about doubled from what it was running before this recent period. So how do you judge productivity? What are you watching?
I mean, the simple is and you hinted at this at the question, which is we look at the economic growth, the GDP numbers, and we look at how many people are working and how many hours they're working. And if businesses aren't hiring very many people, then the same number of people, but they're having big profits and big earnings and big economic growth, the same number of people are producing more, which suggests their productivity is going up. But as you also said, these numbers tend to get revised. And sometimes it takes a long time to really see the underlying trend because the numbers are volatile. So sometimes it takes a long time to see the underlying trend in productivity. And so, yeah, some early last couple of years, productivity's kind of surprised us, but I think it's too soon to say that AI is already leading to a boost in productivity. It could be that, coming out of the pandemic, businesses couldn't find workers and they had to restructure how they did their basic operations to just do more with the few workers that they had. That's productivity enhancing even before you get to AI.
Yeah, and then so, speaking of that, one of the things that's really striking is how resilient this economy has been over the past couple of years. I mean, like you'd mentioned earlier, the war with between Russia and Ukraine. I mean, it's been hit by one thing after another. But when you look at least the headline numbers, you're going, it's still growing. You still got a relatively low unemployment rate. So, what have you taken away from this recent experience where these blows, at least I think traditionally, we would have said, "Boy, it's gonna at least bring us to a recession or at least close to a recession."
Yeah, you were right. I mean, the US economy continues to prove to be much more resilient than I think most people, and myself included, expected or understood it to be. I also think the fact that there's been this massive new investment in AI and data centers has been an engine for growth that has actually dragged forward other sectors of the economy at the same time. So that's been very positive. And by the way, I wouldn't trade places with any other country in the world. Every country has its challenges. Most have far more challenges than we have. So we're very well positioned competitively. And of course, in the energy sector, we are more resilient to energy shocks than most countries because we produce so much domestic oil and gas.
So when you're at the monetary policy meetings, now you're a voting member, and I at least I imagine that someone's gonna say, "The stock market's at a record high. Consumer sentiment, at least by the measures that we have, that seems to be at a record low. Reconcile this for me."
It's very hard to explain what the stock market is doing in any short period of time. Corporate profits continue to climb, so large corporations at least continue to do very well. Small businesses, I think, are experiencing something different and may be facing more challenges, more akin to what consumers are facing. We also see a range of customer experiences across income levels. So well-to-do Americans are traveling, are buying luxury goods still. Lower income Americans are pinching their pennies, shopping at discount stores, trying to make ends meet. And so it's not just the stock market versus customers. It's even within customers and within businesses, the different experiences that people are having.
And you were deeply involved in, the last real credit implosion that we had, right? And I mean, you were right there. Now there's a lot of concern about a more opaque market, but this rapid growth in private credit and sort of difficulties about valuing stuff. How close are you watching this? How concerned are you about some of the issues that are going on in private credit?
We're all watching it very closely because the market has grown into a $1 trillion market in a pretty short period of time. But there's some elements of it that give me more comfort that we're not headed for an '08 type crisis. One of the real building blocks for financial risk is leverage. So banks are leveraged, let's say 10 to 1. You and your listeners deposit your paycheck, and then the banks have capital. They borrow 10 times as much as the capital that they have. So they're levered roughly 10 to 1. So if they make a small mistake in the investments that they make, they can wipe out their capital, wipe out their equity pretty quickly. Private credit vehicles tend to be levered, let's say 1 to 1. So there's less leverage in the system. And while you can go to your bank tomorrow and say, hey, I want my money back, private credit is more like a certificate of deposit. It's harder to get your money out of these private credit vehicles. So, for some fundamental reasons, private credit should be a safer structure than a bank, less vulnerable to these kind of really risky scenarios. Having said that, in your question, you pointed out there's a lot of opacity in what's underneath these vehicles. And there are connections between vehicles that are sometimes hard to track. And maybe there's embedded leverage that we don't see. So, in no way do I want to signal the all clear. We're watching it carefully. We think there are some structural features that make this sector more resilient to a downturn, but we're going to keep watching it carefully.
So one of the things I always imagine is that, we all, I lots of us have opinions of what Fed policy should be, what I would do if I were in the chair. But you've been at the Federal Reserve Bank for 10 years now, head of it, and then you've been a voting member multiple times. What have you learned about monetary policy in that span that you didn't necessarily know when you took the job?
Well, first of all, someplace we started in this conversation, the labor market is a lousy, lousy, lousy forecaster of inflation. And the problem is, most of our financial models trying to forecast inflation start with the labor market. So I mean, we're really trying to, I mean, it's amazing the Fed's been around for 113 years, but our understanding of the embedded, like what is driving inflation in a given quarter or a given year, it could be any number of things. We don't have good models for how supply chains break and how supply chains heal. How do I answer that question? I call big businesses in Minnesota that have global supply chains and I say, tell me what's happening in your supply chains. When are your supply chains going to normalize? Just a couple of weeks ago, CEO of one of the major companies in Minnesota told me that they've estimated even if the Strait of Hormuz opens tomorrow, it will be months before their supply chains return to something like normal. So that's an inflation process. So our ability to forecast that and model that is deeply limited. And so I think the first lesson I have is just one of humility of how hard it is to actually have confidence that we know where inflation is heading. That doesn't let us off the hook. We still need to get it back down to our 2% target. But I wish I knew with confidence exactly where it was going. And then I'd tell you exactly when we get it back down to target.
And why 2% at this point? There was I haven't read that much recently, but if you went back, 2 years or so, there's a lot of commentary, "Well, let's make it 4% as opposed to 2%."
Yeah. As you said, Americans hate inflation. And so we want a low enough number that people don't have to think about prices, don't have to think about what it means for their paycheck. Let's just get it back in the rearview mirror where, so families can think about their kids and their jobs and their futures, and nobody has to worry about inflation. So we want a low number, something slightly above zero to give us some margin for error, but low enough that people don't have to think about it. And that's why two and not four.
And one of the issues and you've seen these numbers, but it is getting kinda unbelievable just how much, federal debt that we're carrying. And, depending it doesn't matter whose forecast you're looking at, it's a large number. How does that, fiscal situation have an impact on monetary policy?
Well, it can have an effect on inflation over the long run. It can have an effect on government borrowing costs and these neutral rates that I talked about. In the near term, it's not having much effect. We have about 100% of debt to GDP. The problem is nobody knows where the danger zone is. If the government gets to 120%, is that where inflation really takes off or people lose confidence in the dollar? It really is an issue of confidence. When do investors around the world conclude, hey, I'd rather invest in China. I'd rather invest in Europe. So right now, investors around the world still have the most confidence in the US economy, which is great. But if the debt to GDP gets to be too high, at some point investors might say, you know what, I'd rather invest someplace else because their political system can make the tough choices that America so far has not been able to make. I mean, this is not a job for the Fed. This really is one for the fiscal authorities to come together. But at some point, they need to come together and make these kind of choices to be able to get us on a sound path.
Where do you get your diversity of viewpoints? Because one issue all institutions deal with is, you know, the echo chamber.
Yeah. Well, one thing, if you were able, and you're not allowed, but if you were able to sit in my policy briefings, we have a brilliant team of PhD economists at the Minneapolis Fed with close partnership to the U. Um, our policy meetings, briefings are like intellectual wrestling matches. I mean, just in that conference room, they are not shy about telling me when they disagree with me, and I'm not shy about telling them when I don't believe their analysis. And then we wrestle it out, and I walk out of those meetings with a lot of confidence that I've heard all the arguments that one could bring to bear on a given topic. And then I talk to a lot of businesses and community groups all around the region. And then, of course, you've got 12 Federal Reserve Banks. So when we go into the Federal Open Market Committee meeting, each of the 12 Reserve Bank presidents is bringing their own perspective, backed and challenged by their own team of researchers. Congress created this system 113 years ago with 12 Federal Reserve Banks with all the regions represented. I mean, there was some real wisdom in that model because it leads us to challenge one another and not just opt for, hey, whatever Washington is saying necessarily is right.
Well, thank you very much for your time. I really appreciate it.
Thanks for having me, Chris. Good to see you.
Neel Kashkari is president of the Federal Reserve Bank of Minneapolis. Office Hours is a production of Matriarch Digital Media, hosted by me, Chris Farrell, executive producer, Twyla Dang, producer and editor, Beth Gibbs, music by Bob Bradley. A special thank you to Heller-Hurwicz Hannah Fairman and Janine Sorrell. Subscribe to Heller-Hurwicz Office Hours to hear about the economic research being done at the University of Minnesota. And to learn more about the research we discussed today, visit hhei at umn.edu. Thanks for listening.